Well, thank you for joining us today. Welcome to our first home buyer webinar. We're very excited to be doing our first webinar today and look forward to bringing you more of these in the future. My name is Nitish Kumar. I'm a franchise owner with Loan Market and I'll be your host for today. I'm going to be joined by Michael Miller from Wealth Market, who's been in financial planning for over 15 years, Troy Reddick from Ray White Sales, who's been in real estate for over 20 years, and Lisa Donnellan from Ray White Property Management, who's just done her 10 years in real estate. So you're going to have a lot of experience, people talking to you about how to buy your first home. First thing we're going to talk about is just a few housekeeping rules for today. So we have had some questions sent to us prior to the webinar that we will answer at the end. But if you do have any live questions, please put them in the Q&A section and we will endeavour to get to them at the end as well. If you have any detailed questions you want to ask about your personal circumstances, we will put up the speaker's details at the end so you can email them directly or call them. And we will send you a link to the webinar within 5 business days as well. Now we will try to keep today to 30 minutes depending on the number of questions we do have. And it is our first webinar, so if we do run into technical issues, please bear with us. So first thing we're going to start with is talk to you about what assistance is available to you as a first home buyer in forms of grants and concessions from the ACT government, New South Wales government and the federal government. So the first big one is the stamp duty concession. It really saves you about $15,000 to $20,000 in stamp duty depending on how much you're looking to buy for and allows you to get into the market quicker. Now there are some differences between ACT and New South Wales that we're going to talk about. The first one is ACT is income tested, so you have to be earning less than $160,000 as a household to qualify. That number does go up by about $3,300 per dependent that you have. New South Wales doesn't have an income threshold, so you could be earning $200,000 and still qualify for the concession. In New South Wales, you can never have owned a property before to qualify for the concession. Now, ACT is very unique in its nature where if you haven't owned a property for more than 2 years, you actually re-qualify for the stamp duty concession as a first home buyer. We're the only territory or state in Australia which allows for that. So if you got out of the market 3 or 4 years ago and you want to get back into the market, you can get a discount on your stamp duty again. In the ACT, you do have to live in the property for a continuous 12 months and you have to move in within 12 months of settlement. New South Wales, however, you only have to live in it for 6 months. Now, the reason government allows 12 months for you to move in is if you're looking at properties that are currently tenanted, you can't legally kick out the tenant. And Lisa will talk a bit more about that later. But it gives you time to let the lease run its course before you move in and not miss out on your concession. The other big difference is price restrictions. So in the ACT, we don't have any price restrictions on stamp duty concessions. New South Wales, however, we do have some price restrictions. So up to $650,000, there is no stamp duty. But between $650,000 and $800,000, you do have to pay a discounted stamp duty. So it's not the full amount, but it's also not $0. So somewhere in the middle. And the closer you get to $800,000, the smaller the discount obviously gets. Then the next big one is the ACT stamp duty deferral. This is the least known assistance program that's out there. And it's primarily aimed at people earning more than $160,000 who don't qualify for the stamp duty concession. It's available on new and established properties. Now this one does have a limit, so $750, the property has to be under that. And you have the ability to defer the stamp duty with the ACT government for up to 10 years. And the reason you would want to do that is so you can put a larger deposit in towards your home loan and minimise your mortgage insurance, or get into the property a little bit sooner than you would otherwise be able to. You do have 2 options paying back that money to the ACT government. So option 1, you can start making repayments from day 1 up until the end of year 10. Option 2 is you can make no repayments for the first 5 years, concentrate on paying down your home loan, and then start making repayments from year 6 to year 10. Now, if you do happen to sell the property in those 10 years, you do have to pay back the stamp duty at that point in time anyways. Now, the next one is the New South Wales First Homeowner Grant. ACT no longer has a First Homeowner Grant. That was removed in 2018. But New South Wales, you can still get $10,000 if you're over the age of 18. There is no income threshold on this one. And same as the concession, you can never have owned a property to qualify for this. You do have to live in it for 6 months, and it is only available on new properties, not established. Now this one, the price limits are a bit different depending on if you're buying a house or if you're building a house. So if you buy a finished brand new house, the limit is $600,000 in New South Wales. If you're buying a land and doing a build contract separately, can't be more than $750 combined. Now, the most popular scheme for first home buyers at the moment is the First Home Loan Deposit Scheme. It started on the 1st of January 2020. And there's 10,000 spots per financial year. So we've just had another 10,000 spots released at the start of this month. Now this one is a federal scheme, so you do have to be a citizen, whereas with the state assistance programs, you only have to be a permanent resident. This one does also have an income threshold, which is $125,000 for single applicants or $200,000 for couples. And now this one also has price limits on the property that you're able to buy. So in the ACT, that price limit is $500,000. In New South Wales, it's $750,000 if you're buying in a metropolitan area, or $450,000 elsewhere in New South Wales. There are a couple of limitations to this scheme. The banks that you can go to are limited to 27 different banks. So there's 2 major banks, which are the Commonwealth Bank of Australia and National Australia Bank, and then there's 25 non-major banks as well. The other restriction on this one is you do have to continue to live in the property while you're on the scheme. So unlike the concession, you can live in the property for 12 months with the concession and then rent it out. With this one, you have to continue to live in it while you're on the scheme. If you do rent out the property, you do have to come off the scheme and go to a normal loan. Now, due to COVID, both the federal government and the ACT government announced some new incentives to stimulate the construction industry. The first one, being a federal scheme, is the HomeBuilder Package. This is broken up into 2 parts. Part 1 is if you're building a new property or buying a new property, you get a $25,000 grant from the Australian government. The price has to be $750,000 in total, and you have to sign a contract between the 4th of June and the 31st of December this year. The construction has to start within 3 months of the contract being signed, and it is only available on occupied properties. Now, this one's not restricted to first home buyers though. So if you own a property already and you're looking to downsize or upsize, you still qualify as long as you're going to live in the property. The second part of the HomeBuilder Package is if you're doing a substantial renovation to your property. You'll get a $25,000 grant from the government on your owner occupied property again, as long as the renovations are a minimum of $150,000. Same thing with this one, you have to sign with the licensed builder between the 4th of June and 31st of December, so you can't do the work yourself, and you have to start construction within 3 months of that contract being signed. It cannot include work like pools, garages or sheds, so it's got to be work to your actual property itself. The ACT government also announced some changes on the 4th of June in line with what the federal government had done to again stimulate the construction industry. So the first one is there's no more stamp duty on vacant blocks of land if you're purchasing a block to build an owner-occupied property on. Second one is if you're buying a brand new property, whether that be an apartment, townhouse or a house, up to $500,000, there is no stamp duty on that purchase. And if you're buying between $500,000 to $750,000, you get a discount of $11,400 on that purchase. Now, this one goes for a bit longer than the HomeBuilder Package. You do have till the 30th of June next year to sign a contract, and is available to any buyer as long as it's going to be on an occupied property. So again, if you're downsizing or upsizing, you will still qualify for this. As you can see, there's a lot of different schemes out there that are available and can be quite confusing as a buyer. So if you're not sure which one to qualify for, get in touch with a broker and they can help you out with it. Now, we're going to have Michael Miller from Wealth Market come along and talk to us about budgeting to save the first deposit. Michael, thanks for coming today.
Hi, Nitish, thanks for having me.
So we've been talking about a concept called lifestyle creep over the last couple of months. Would you be able to tell our viewers a bit more about how lifestyle creep works?
Yeah, so lifestyle creep, it's all about as you get pay rises, increases in your income and things like that, well, your lifestyle just creeping up along with it. So you start going to a nicer restaurant, you order a nicer bottle of wine, and that's all fine. You want to have the nice things in life. But what that does, and this next sort of page sort of demonstrates, is if that lifestyle creeps up, you've got your income and that's sort of jumping up as you get your pay rises, your pay reviews and things like that. But the spending is going with it. And what that means is that gap in between, that's what you can actually save for that deposit, is it's pretty much staying the same. So you might have be 5 years sort of out of uni, finishing an apprenticeship, something like that, and you're still saving what you were right at the start. Now, if you can keep that a little bit under control, I mean, nobody's going to actually deny that as you get yourself those pay rises, you should enjoy a bit of that. But the next slide here sort of looks at, well, if you just increase that at a bit more of a steady rate, what you do is at the start, you're still sort of saving a little bit, because when you get your first job, it's pretty normal actually that you're going to be spending most of what's coming in. But as you get those sort of pay rises, increases, things like that, you're able to just keep growing and growing and growing that amount that you're saving. Yep. And that's where you get the real power of sort of saving that deposit.
Perfect. Now, the federal government did announce a scheme in 2017 to help first home buyers save a deposit a bit quicker by using their superannuation. Would you be able to tell us how that works?
Yes. So this is separate, of course, to people are able to access some superannuation to do with COVID. This scheme's been around since before then. One of the key things is you're able to withdraw money that you've put into super, but it is extra voluntary contribution. So it's not what your employer puts in for you and has to put in for you. It has to be those extra contributions, and it's to fund the purchase of a first home. You're not eligible for this one if you've ever owned any property. So regardless of whether it was somewhere that you lived or an investment property, all the contributions that you've made from 1st of July 2017 are eligible for this scheme. So even if you hadn't, say, thought about using this in a deliberate way, but you've been putting some extra into your super, that may actually be accessible under the First Home Super Saver scheme. So there are a couple of limits. You can contribute up to $15,000 a year per person. So one of the things to remember is if you are buying as part of a couple, is you may effectively be able to use this program twice. You can use pre-tax super contributions. So people might have heard of that referred to as salary sacrifices, quite common. And that often gets you a fairly substantial tax saving compared to just taking the money as salary. And you can accumulate in the scheme up to $30,000 per person. So if we look at that $15,000 a year limit, somebody who was doing that every year, they might get up to that limit within 2 years, or they might sort of be doing $10,000, $6,000 a year, so they may do that over a couple more years. The best way to sort of illustrate how this scheme works is with a case study. So we've got one here where we've got Kelly, who's worked out that she can save about $375 a fortnight out of her wages. So that's what she was thinking, well, I'm going to go and put that towards my deposit. We've got a note there, good work. That's actually saving 20% of your income. Like, that's a fairly substantial amount. What Kelly could do is she could salary sacrifice $575 a fortnight. So that means she goes to her employer and says, hey, don't pay me that $575 a fortnight as wages. Put it into my super instead, and it comes out before tax. Now, the result of that is Kelly's pay is reduced. What she gets in the hand by $377 a fortnight. So give or take that $2, she's in exactly the same position as if she'd saved that $375. Where the benefit comes from is Kelly's super. She does have to have some tax taken out of that contribution, but it's actually growing by $488 every fortnight. So there is already more sort of going into the pool to start with. And if Kelly was doing this for 2 full financial years, she saved $19,500 if she was just taking the money, putting it in the bank or something like that. But she would have actually grown her super by just over $25,000. So she's getting pretty close to that $30,000 limit there. If she then takes that out, there is a little bit of tax. So we've done a bit of an estimate there, a bit over $1,100. But the end result is, through using that scheme, Kelly's got an extra $4,734 available for that deposit. Not by saving more, not by saving less, just by saving the exact same amount she was going to, but by using this scheme. So the final point that I'll make, and I've got some very helpful pictures there, is sometimes I know, Nitish, people might come to you sort of thinking, oh, I want to buy, what do I need to do to get a mortgage?
Yeah.
And they might have a couple of pre-existing debts. Yes. Credit cards, maybe some store cards. The heading I've got there is, we work with humans, they're much nicer. And that's my prompt to, I've got my picture of sort of our human spreadsheet there. The guy, he's doing all his formulas, and what I call a spreadsheet strategy would say, well, let's say we've got a store card with $800 on it. The interest rate is 6% a year, and we've got $8,000 on a credit card where you're paying 15% interest. The spreadsheet strategy says, well, clearly the credit card, it's at 15% interest, should pay that off first.
Yep.
And that's definitely the way that the numbers go.
Yep.
But one of the things that we know is paying down those debts is really important to being able to get the home loan.
Yes.
But it's not actually a lot of fun.
No.
So one of the strategies, it's what's called, this leads to my other picture here, is called domino your debts. So rather than sort of starting with the highest interest one, particularly when that's a bigger balance, what you do is you start with the smallest debt first. Because what it means is, we use that example, you've got $800 on the store card. You might be able to, actually pay that off, over sort of, 3 to 6 pays of really sort of working quite hard on that.
Yep.
And then you get that really sort of satisfying moment of that one's done, over, and it just makes it a little bit fun.
Yes.
Which gives you a bit of that energy and momentum to then move on to the next one. So it's not, if you put it through a spreadsheet, it doesn't actually come out in the better strategy. But if you think about what we as people are actually like,
Absolutely,
that can work much better.
I agree. It's really important to keep motivated during your savings. It can take a while to save that deposit. So thanks for coming along, Michael. Really appreciate it.
No worries.
Now we're going to have Troy Reddick from Ray White Canberra. He's been in real estate for over 20 years, like I said earlier. He's by far one of the best auctioneers in Canberra. So quite excited to have him to give us some tips about auctions and how first home buyers can be better prepared for an auction. Troy, thanks for coming along.
Thanks, Nitish. Good to be here, and hi everyone out there.
So mate, first question I've got for you is, why are auctions so popular at the moment?
Yeah, everyone's asking us that question. There's a lot of auctions, a lot of property that is going to the market is going by auctions. The perception out there is that the owners are chasing the highest price, and I guess there's an element of that, but I reckon the number one outlying reason at the moment is that the owners out there are chasing certainty. There's a little bit of uncertainty in the marketplace, so the certainty that they get at auction is because the buyers are unconditional. There's no cooling off period, there's no subject to finance, and of course if the price exceeds expectations, great for the owner, but I think it's really locking in the deal on the day that they're chasing. The other thing we hear too from buyers is that I don't like auction, I always get outbid, or there's always too much competition. I don't actually believe that this is solely an example of auctions. Yes, there can be competition at auctions, but there can also be competitions for homes with just a price on. So it's not an auction, you can't blame it on an auction, it's obviously that you're looking at the best properties on the marketplace.
And how does an auction differ to, say, a private treaty sale?
Yeah, good question. I guess the main difference is in how the home is negotiated. The advantages of bidding at auction, I think, are threefold. The first thing is the transparency of negotiations. You can clearly see everyone's bid, and a lot of people say that's better than these under the table or behind the scenes negotiations. You get an instant answer on your offer. You don't have to wait for 24 hours. You get an answer straight away. And in just about every case, you're dealing with a motivated seller. Most sellers are prepped to accept the best price on the day. So it's nice to know that your owner is also motivated.
Perfect. Now, a lot of our viewers are first home buyers. What should they get prepared prior to going to an auction?
Yeah, it's a good question. The main difference with auction as well is that it's unconditional on the day, as we've already said. There's no cooling off period. So it does mean that your preparation pre-auction is absolutely critical. A couple of things that I'd recommend: have multiple looks at the property, perhaps at different times of the day, so you can really get an understanding of what you are buying. Gives you a chance to bring family or friends through for their opinion. Always request a copy of the contract. That includes the building reports if you're buying a home or townhouse. And it's worth talking to your solicitor about that and getting some legal advice. Of course, need to talk to your mortgage broker. No point going to auction without the finance in place. And if there's any terms or conditions on that contract you want to negotiate, such as settlement times, deposit amounts, that needs to be done before the auction itself.
Perfect. Now, controversial one, price guides from agents. Should our buyers believe the price guides from agents?
Yeah, look, it's a contentious point at the moment, and I guess as an agent, you get questioned on that all the time. You can use the price guides as a guide. I guess that's why we use it as a guide. Essentially, though, as a buyer, you need to become the expert on pricing. And never before has there been so much information available out there. Online, you can get out and do open homes, you can get out and see the auctions. So if you're looking to spend a decent chunk of money, and let's be honest, we're normally spending $500,000 or more, you really do need to do your homework here. I suggest hitting up the open homes, going along to auctions, tracking sales online, so then you can actually determine whether the agent's price guide you believe is accurate or not. Also got to remember too, I guess, that sometimes an agent can be surprised about the strength of bidding. Sometimes an agent can be surprised about the flexibility an owner might have on the day. So please just use them as a guide only.
And what do we need to prepare for on the day?
Yeah, on the day itself, it needs to be early. There's a registration process involved, and if the auction is on site, the registration process normally starts 30 minutes before. So I suggest getting there 30 minutes before the auction. If it's a in-room or a online auction, the registration process normally opens at around about 7 days before. I suggest getting that part of the process done as soon as you can. All buyers need to be present. So if you're buying as a husband and wife, both of you do need to be there. From that point, I guess the main question we get asked is, what's the best tactic? Do I come in hard early? Do I leave my best bids late? We often joke, Nitish, that the best strategy is to have the most money.
Yeah.
And I guess it doesn't matter what your tactic is. If you come up against somebody with more money than you, you're probably going to lose out. Second best tactic is to make it look like you've got the most money. In essence, I don't think there's one tactic which will always win you the auction. If I'm bidding at auction, I like to state my intentions loud and clear. I'll come in hard and fast at it and hopefully perhaps intimidate the rest of the buyers there.
What happens at the fall of the hammer? So you bought the property, what's the next step from there?
Yeah, great. Obviously, the owners, or sorry, the neighbours will come and congratulate you, pat you on the back. You get to meet them, of course. You'll then be asked to sign the paperwork and pay the deposit immediately on the fall of the hammer. There's the obligatory photo in front of the signboard with the sold sticker that goes on. Hopefully, you get a bottle of champagne out of it as well. And it's time to celebrate. Awesome. In essence, Nitish, it's just a clear, easy process to buy a home from. You do need to be prepared, but in essence, it's a great way to buy.
Last one for you, Troy. Should we have a price limit before we go to an auction?
Yeah, good question. Again, a lot of people say always come to auction with that price limit. And I would never recommend going above the price limit that the bank's given you. What I also understand too, though, is that a lot of buyers, the limit that the bank gives them is actually more than what they do want to spend. In that case, I think it's worth keeping in mind that even an extra $10,000 on the purchase price might only add $40 per month to your repayments.
Yep.
If an extra 10 at the auction day means that you get the property you want, personally, I think it's worth paying the extra $40 a month. Real estate has historically been a great investment as well. So if you're there for the long haul and looking to own that home for the next 10 or 15 years, which most people are, I don't think you can go wrong. I wouldn't go with a firm limit, but never go against what the bank has told you can lend.
Thanks for coming along, Troy.
Pleasure.
Appreciate your time.
Thank you, everyone.
Now we're going to be joined by Donnellan from Ray White Property Management. She's just going to talk to us about a few legalities around properties that are currently tenanted. Lisa, thanks for coming along.
And Nitish, thank you.
The first question I have is, if a first home buyer is looking to buy a property that is currently tenanted, what notice do they need to give to the tenants?
So there's two parts to this. If a tenant is on a periodic tenancy, they must be, to get them out, they can be given 8 weeks notice.
Okay.
If they're on a fixed term tenancy, there's two ways of going about it. If they're in the first half of their tenancy, they can be given a 26-week notice to vacate, which will expire on the last day of their fixed term tenancy. Otherwise, wait till the lease is over and then give them 8 weeks notice.
And a lot of our first home buyers are currently renting as well.
Yep.
What notice do they need to give to their landlord?
So if they're on a periodic tenancy themselves, they can be given 3 weeks notice. If they're in a fixed term tenancy, really the only way to get out of it is to pay a break lease compensation to an owner.
A lot of the first home buyers did pay a bond when they moved into the property. What should they do to make sure they get their bond back once they move out?
Best thing to do is make sure you hand the property back in the same state as you were given the property. So use your inventory and condition report as your starting point, minus a little bit of fair wear and tear. Report any damage and repair any damage to the property, and any damage from pets must be fixed.
Perfect. Thanks for coming on, Lisa. Really appreciate it.
Thanks, Nitish.
Now, we've had a few questions sent to us prior to the webinar, so we'll go through them first, and then we'll check the Q&A. The first question is for me regarding pre-approvals. Is it a legal requirement to have a pre-approval before you go to an auction? No, it's not a legal requirement to get a pre-approval before you go to an auction, but please make sure you've spoken to a broker or your bank about your finances. And make sure if you do get a pre-approval, it is a credit assessed pre-approval. A lot of banks at the moment are doing what's called a computer pre-approval. So you put the data into the computer, it shoots out a pre-approval very quickly for you, but no one at the bank has actually checked that data. So it's not really worth the paper that it's on. Whereas a credit assessed pre-approval, which is what we tend to do, it's been looked at by a human being at the bank, and they've looked at all your incomes, assets, liabilities, and made a firm decision on whether they're going to go ahead and give you a loan. And they may come back and ask some more questions, but just be mindful the difference between a computer pre-approval at a branch or a credit assessed pre-approval. So next question we have is for Troy.
Fire away.
What was the question, Katie?
There's one about how to pay deposits I saw come through earlier. There's a lot of first home buyers say, how do I pay my deposit at auction if I'm successful? Best to check with the agent you're dealing with there. EFT is the easiest way. Just make sure that you have avoided any daily transfer limit. Also make sure you negotiate the deposit amount prior. 5% deposits are quite common. If you're buying through Ray White, we have a great what's called an auction pay or DEF system, where we can simply deduct the money out of your bank account, assuming you've got cleared funds in there.
Does the 5% need to be negotiated before the auction, or is it standard nowadays?
No, it does need to be negotiated. The standard amount is 10% of the purchase price. Most owners and agents are happy to accept 5%. It is worth checking though before you bid.
Perfect. Thanks, Troy. The last question we have from previously, prior to the webinar, is from Michael. Michael, the question we had is, we've got our mortgage now, we've got our house. Should we be putting extra money towards the mortgage or superannuation?
Yeah, so it's a very common question. And the best way I can answer this is super is the most tax effective place that you'll ever find to invest. That's the real benefit. There are a lot of tax concessions and the like there, but it is hands down for your retirement. Now, under current rules, that means at least age 60 and potentially a little bit more by the time we get there. So it is the worst place to put extra money for, say, your emergency fund if the car breaks down, if you need to save for kids' education, or things like that. So if it's something that you may actually need to sort of draw on before retirement, put extra into the mortgage. If it's really money that you're saving for that retirement, then super is really, really tax effective. But the other thing I also come back to is the adage of why not do both?
Yep, do a bit of both. Perfect. Thanks, Michael. We'll just check the Q&A and see if you've got any live questions. We'll just give it a minute, and then thank you for joining us for today. We put up the speakers' details. So if you do have any direct questions for the speakers, please get in touch with them, and we will send you the recording within 5 business days of today.